Okay, hello accountants. Today we're looking at Unit 8, Section 2's first assignment titled Adjustments and the 10-column worksheet. So don't let that 10-column worksheet be intimidating to you, okay? It's actually pretty easy, and we're going to break it down. And in this first assignment, all we're looking at is the trial balance column and the adjustments columns. Trial balance columns and adjustment columns. So we're kind of breaking it down, and those are the two columns we're looking at first, or the two sections, I should say. So in part one, it states that the inventory account of Olympic sportswear is as follows. The account balance for merchandise inventory is $75,000. And the actual physical inventory is $71,500. So you might be wondering, like, how does the amount change, and why wouldn't they have recorded it? In this case, it could be that maybe the value of some of our items has gone down, and that led to the decrease in value of our physical inventory. So we need to account for these adjustments and fill out the correct T accounts and make the appropriate journal or worksheet entry. So what we do first is we look at our merchandise inventory. We have a balance of $75,000, and our actual physical inventory was $71,500. So now we need to identify the accounts that are going to be affected. The first one's pretty easy. Kind of tells you we're looking at merchandise inventory. And if you've read through the text, which I'm sure you have by now, you will know that income summary is the other account that we're working with when we look to adjust merchandise inventory. Because since merchandise inventory affects our overall value of our company, this is an owner's equity account, income summary is. So then to classify the accounts, merchandise inventory is an asset account, and income summary is an owner's equity account. So now we want to identify which account's increasing and which account's decreasing. If we were seeing that we had $75,000 in our merchandise and it went down to $71,000, so obviously that's going to be our decreasing account. So if, well, I guess we'll apply the debit credit rule in a minute. So let's say merchandise inventory will decrease, income summary will increase. We want to apply the debit rule. Not merchandise inventory because they are decreasing. And since income summary increases on the debit side, we will copy it into there. And I also want you to list the amount. So we basically, how we figure that out is we take 75,000, my calculator here, 75,000 minus 71,500 gives us $3,500 that we are increasing and decreasing. And then apply the credit rule. Alright, so then you need to create the appropriate T accounts for each of those accounts that I just listed for you. And then you also need to copy them into the worksheet. And I know your instructions tell you to make a journal entry, but we're actually copying this into the worksheet. So it's simple enough. We copy in our merchandise inventory, which we had a balance of $75,000 originally, so you need to copy in what your trial balance was, and then we make the adjustments. So then we have income summary. So we have our trial balance of merchandise inventory was $75,000, which we caught up here. And so now we need to make those adjustments. So we are crediting merchandise inventory and debiting income summary. So we're crediting merchandise inventory and debiting. And another thing you should do in your adjustments column, if you read the text, you should be labeling your adjustments. So like for instance, this is the first adjustment that we're making, and so when I go through my worksheet I can tell where these adjustments are matching up at, because when you look at a full worksheet, which you can see in your text, these accounts are not right next to each other. It's just kind of set up that way for our worksheet purposes, our assignment purposes. So make sure you're always labeling your transactions so that you know, okay, I see my A transaction here, I need to go up and look for my other A transaction, there it is, they match, we're good to go. So that is part one. Part two, and of course now my formatting is going to be all off. Part two is the exact same thing, only you'll notice that our inventory has increased. So maybe the value of certain items has actually increased that are in that's in our inventory. So now we are going through the exact same steps, only you're going to kind of reverse it because we're increasing. So you need to figure out the difference between the $75,000 and $98,200 and record those appropriately. Okay, accounting for the increase. So your merchandise inventory, you need your balance again of $75,000, but you're starting with $75,000, and then you should be debiting merchandise inventory because we're going to increase it, and then crediting what account? I'll let you figure that out. In part three, we're looking at our supplies account. So we're going through the exact same steps, only up here you'll notice that we had a beginning balance of $7,200, and then we purchased $5,000 worth of supplies over the year, but then our ending balance ended up being $2,200. So the value of our supplies, we either used up our pens and pencils and papers or whatever, and we ended up with only $2,200 left. So now we have to account for that adjustment. So you're going to start off with, you're going to add this $7,200 plus $5,000, and that's going to be the amount you're going to start working with, and then you ended up with $2,200. Okay, so those are the amounts you're working with. So I'll fill this in for you. Supplies, we started with $12,200, excuse me. Okay, so then you need to make the appropriate adjustment amount. And also refer to your text if you're unsure of what account supplies works with. It should be pretty easy to. Up here with merchandise inventory, we worked with income summary, and the text tells us that these other asset accounts, they have a related expense account that we should be working with. So keep that in mind. And in part four, it looks like we're working with insurance. So the same kind of thing, list the type of accounts that we're working with. This would be, for instance, let's see, prepaid insurance, and then also insurance expense. Okay, so those are the two types of accounts you're working with. And so fill out identify your accounts, classify, analyze, give me some T accounts, and put them in the worksheet, please. And then finally in part 5, we are looking at our federal income tax. And this one I'm going to help you out with because it has some account names that we haven't really worked with yet. So what they want you to call these accounts, and you should have read in your text that this 10-column worksheet deals with a corporation, and the 6-column worksheet that we dealt with in Accounting 1 is more of a sole proprietorship, what they would use. So when we're looking at these accounts, we were working with Federal Corporation Incorporated Tax Expense and Federal Corporation Incorporated Tax Payable. So if you want to cut those down into a way that makes sense to you, that's certainly fine with me. Like maybe spell them out up here, but then when you go to make your T accounts, maybe you call it Federal Corp Tax Expense and maybe Federal Corp Tax Payable. Okay, that's perfectly fine with me. And then so you'll classify these accounts, apply your debit credit rules, fill out these T accounts, and then fill in the worksheet. Okay, so it's pretty much the same steps for each part. Just make sure you're reading through the text and figuring out which accounts go with each account. So for instance, again, merchandise inventory, we're working with income summary, prepaid insurance, we're working with insurance expense, and so on. So definitely refer to your text or shoot me a K-mail if you have any more questions.